Is Pepsi the best consumer staples company in the world? Is it better than Coca-Cola, and can it protect us in the current inflationary environment throughout the world? In this video, I'll answer all of these questions, and I'll also analyze Pepsi's latest business results and fundamentals. As always set with educational purposes and is not meant to be taken as financial advice. Alongside Coke, Pepsi is a major leader in the soft drinks market space. According to Statista, in 2022, PepsiCo controlled around 26% of the US carbonated beverage market, down from 30.5% in the mid-2000s. Coke, on the other hand, has around 44% of the US market share. In the US, around 3/4 of the carbonated soft drinks market and beverage industry is controlled by Coca-Cola and Pepsi alone. Unlike Coke, Pepsi also has some big bets in the snacking market space as well. In the following picture, you can see the most famous brands of Pepsi. Ruffles, Cheetos, Doritos, Walkers, and Lay's make Pepsi the biggest potato chip company in the world, and who does not like potato chips? Pepsi also owns Gatorade, Mountain Dew, Lipton iced teas, and others. This is a main differentiator between Coke and Pepsi. When it comes to the snacking market, Pepsi is a dominant player. Pepsi has an insane 39.1% market share in the space, with their second biggest competitor being Kellogg with its only 6.4% share. This market share is in the US. As stated by Statista, the snack food market is expected to grow by 5.65% annually over the next 5 years until 2027, which is in line with the soft drinks market, which is expected to grow by 5.76% until 2027. As a leading company in the consumer staples space, Pepsi has quite the inflationary protection. When prices of goods go up, Pepsi just increases its prices, and these higher prices spill over to the end consumer. The consumer staples sector is famous for the fact that even in recessions, wars, or weak economic times, the sales in the sector never roll over very much to the downside. This is because the products and services in the space are of basic importance for people. In times of a recession, we may not buy the newest car, but 9 out of 10 people will continue to eat Doritos and drink Lipton or Mountain Dew, for example. People look at these products as a part of their basic needs. They do not look at them as their wants. This is why the sales in the space are very sticky. Until now, all sounds okay, but something that I do not like is the current historically high earnings multiple of Pepsi. The current PE of Pepsi is around 25 to 26. About 10 years ago, the level was between 10 to 12. This means that today people are willing to pay 2.5 times more for each dollar of earnings of the company. At the same time, the annual revenue growth of the company is in the range of 2 to 8%, which does not justify such a high multiple. For me personally, I would not want to pay more than a 15 times earnings multiple for such an established business, which has a history of trading at a multiple of 10. If the market sentiment changes and people are less willing to invest, all multiple expansions will contract back to their historical norms, which in the case of the S&P 500 companies is at about 15 to 16. The same could be said for Coke stock, and make sure to watch my full analysis video here on the channel. When it comes to business fundamentals, it is always important to check the debt levels, as in times of monetary tightening, we do not want highly leveraged companies in our portfolio, as this drives the risk much higher. Pepsi has about 95 billion in total assets and about 75 billion in total liabilities. But they have put down $35 billion of intangible assets on their balance sheet, which I am very much against, as these assets are most likely unsellable, which makes them a more of a pro forma asset than a real actual asset. If an asset cannot be sold, then why count it? I just like to be more conservative and remove it from the balance sheet. But when we do this for Pepsi, the equity becomes a negative minus 15 billion, which is by far not ideal. The long-term debt-to-equity ratio for Pepsi is also not good, with a level of 2.07. We want this to be below 1, and a perfect level would be below 0.5. This means the long-term debt of Pepsi is 2 times greater than the equity, and this is even if we take into account the 35 billion of intangible assets. The current ratio of Pepsi is 0.92, which is below 1 and again is not ideal. We want this to be above 1 so that it indicates the short-term assets are greater than the short-term liabilities, which here is not the case. The efficiency ratios are good from an outside look, as the ROE is 57%. But this is due to the very low equity level, which is due to very high debt. This skews the actual results. Prices just need to come down to some normal levels. Until then, I'll keep an eye on these companies, and you make sure to subscribe to the channel and watch all my previous stock analysis videos, as you'll find great value in all of my content. Goodbye for now, and until next time.